This is the slide we showed in January. Didn't change any of the bullets here. Updated the chart of expectations for the Fed funds rate. Two things I want you to key on here. Obviously, at the bottom, if we had known just how big an impact the tariffs were going to have, we probably would have made this trade-related uncertainty bullet a little bit higher up in the pecking order here. The other thing we took pains to mention is that there was expectations that the Fed was going to be cutting interest rates this year. There's a lot of hope built into a lot of asset prices that the Fed would be lowering interest rates, but we didn't think the Fed would be cutting this year unless and until we saw a deterioration of the labor market. And as you just saw in those slides, we really haven't seen that yet. There's pessimism forming about the labor market, but we really haven't seen any significant weakening. And so the Fed has not been cutting rates and has not signaled an intention to cut rates anytime soon, despite everything that's been going on. Let's move one up to the next slide. You can see the impact that we're seeing in terms of the average tariff rate. This is from the Yale Budget Lab. We are now sort of in Smoot-Hawley territory in terms of the average tax rate that we are assessing on imports coming into the United States. Whether you think people are going to substitute away from imports from China, given that they have much higher tariffs assessed than the rest of the world on their goods coming in, depends on that. Basically determines whether you think we're at sort of a 25% rate or more like a 20% rate. But either way, these are the most stringent taxes we're seeing on imports, again, since the Great Depression. And that's having a big impact, even before some of them go into effect, on what consumers and businesses are doing. So if you look at the next graph here, we saw big spikes in January and February in terms of consumer purchases of imported goods and industrial supplies coming into the United States. These are consumers and businesses very rationally saying, we need to import more ahead of the tariffs. We don't know exactly what the rules of the road are going to be in March, April, and beyond. So this just reflects through January and February a big increase in imports, which is going to have an impact on the economic data and have the shape of the economic data as we move through. One example here on the next slide, you can see in terms of consumer behavior, car purchases. March was one of the strongest months on record for consumer purchases of autos in the US. I don't think that's because everybody's car broke down suddenly. I don't think that's because consumers suddenly got a big shot of income that enabled them to go out and buy a car. They're doing this because they think car prices are going to be higher in April, May, June, and beyond. And so this big increase you saw in March is probably going to come at the cost of weaker purchases in the spring months and then into the summer. Now let's go one more forward. And the impact on business investment here, you're looking at the year-over-year change and how much businesses spend on equipment, so capital improvements. That went down in 2018 and 2019, even ahead of the onset of the pandemic, when you saw this relatively small now spike in trade-related uncertainty. And look at the spike now. That blue line is so much higher than it was back in 2019 when we were in the trade war with China. We had a brief earnings recession. We had a brief manufacturing recession because a lot of businesses were pulling back on spending. Think about what this black line is likely to do in the face of much, much higher levels of trade uncertainty. And this is the concern for us moving into the latter part of the year. And then the picture here for the Fed is extremely cloudy. So these policy uncertainties have a way of compounding on themselves. So we have the trade-related uncertainty, which makes it harder for the Fed to do its job when it comes to interest rates, because we're seeing this year falling growth expectations. That's that blue line. Real interest rates are declining over the 2-year tenor, but inflation expectations over the same period are going up. So if you're the Fed and you're stuck between addressing weakening growth outlook and addressing a higher inflation outlook, it's very hard to know what to do with interest rates as a central bank. And the Fed not cutting rates as aggressively as it might otherwise is making Congress's job harder. So let's talk a little bit about that. This was our checklist to start the year for what the Congress was going to have to do. They funded the government for 2025. We didn't have a government shutdown, so check mark there. All these other things are TBD. And I put this bracket here to show that the plan here is to squeeze all of these into one single bill. Raising the debt ceiling, which needs to be done this summer. New spending on some priorities that the congressional leadership has. National defense, some relief for disaster areas and border security. Renewing the Tax Cuts and Jobs Act expiring provisions, which needs to be done by January 1st of next year. Otherwise, everybody's individual tax rates go back up. And some new tax cut policies that the president campaigned on, increasing the cap on state and local income tax deductions, no tax on tips, no tax on Social Security benefits, overtime, potentially corporate tax cuts, although that's going to be a very, very hard one to get over the finish line given the expense. And then some other potential sources of new revenue from the DOGE cuts, from tariffs. It's very hard to know exactly how that's going to factor into the bill, but doing all of this at the same time is a high wire act for Congress, to be sure. And the summer months are going to be, in all likelihood, a lot of people turning their attention from the impact of the tariffs to what's going on in Capitol Hill and how they're going to get this over the finish line before the U.S. Treasury hits its debt ceiling. This is happening in the context of, if we go to the next slide, very, very wide budget deficits for a period of full employment. We are at 4.2% unemployment. We have 6% deficit to GDP ratios in Congress. And these lines for the projections from the CBO assume all the tax cuts are going to expire and the revenues are going to come back up. That's very, very unlikely to happen. So what we're likely to see is larger budget deficits moving forward than we have even today, because the likelihood is that the tax cuts are going to add to the deficit more than any potential spending cuts are going to detract from it. And that's not currently in the CBO's baseline.